The two main things the 70s taught us about investing. It's man, I've been spending all day, man, probably the last couple of days. So I'm researching my course I'm going to do. Initially, I thought it was going to be Investment 101. Now I'm thinking it's going to be investing for retirement. I really, really, really want to see how we can overcome the insanity that was 1966 to 1982. Obviously, the Great Depression, and then the Japanese 1990 to basically 2012. And if we can do, and not like I don't have answers, I'm just gonna be what I'm looking for. That's the premise on my course. So we'll introduce, the information about investing, but I want is investing for retirement. You can't have 70s hit you in the backside, and in 90 to 2012, Japan hit in the backside, and obviously Great Depression. So, and these three things are absolutely counter to each other without question. It's interesting because the 70s inflationary, obviously the Great Depression was deflationary, depression, and then the Japanese was a combination of both, man. I mean, it's kind of like it wasn't inflation necessarily, but it's just rough, and that was a modern era too. So people say, oh, those are the old days. No, not necessarily. Anyway, so one thing, I bust out some of my old investment books, and I'm just reading Burt McKeel's Random Walk Down Wall Street, and this is, what edition is this? I'm not even sure, but this is from 1994. And just like Bogle said here, I found this interesting. He goes, in general, the rule for finding the prospective rate of return of any stock is to add expected growth rate of the company to its dividend yield. The rule works whenever there's no change in the general level of PE. Obviously, such neat calculations are not likely to work out year over year. Nevertheless, over a long period of times, results do average out, so total returns can be well approximated by adding the growth rate to the dividend yield. All right, so, and as John Bogle talks about in Common Sense on Mutual Funds, which you should get the book on that too. Hold on a second. Premise is earnings growth plus dividend yield equals expected rate of return. All right, that's the premise of this. I completely subscribe to that. But on any given year, it's not going to be like that. Because on any given year, you have PE expansion or contraction. PE expansion or contraction. Because remember, everyone's basically buying $1 of earnings. So if earnings growth goes up, that's great. Pablo. Because if earnings growth goes up, that's freaking fantastic. But if people's capacity to buy that extra $1 of earnings is dropping like a brick in water, that's gonna rule the roost here. For the short term, I'm saying, for the short term. And I got evidence of that. So the 70s is very interesting because we know the markets got stomped in the 70s. Everybody knows this. Basically from what I want to see here. So the political calculations .blogspot.com, and this guy Iron Man who writes on Seeking Alpha too. This is one of my favorite websites of all time. So what we're going to do is we're going to come down here and we're going to say 1966. All right. 1966, boink, 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 boink. We'll say, oops, right there, 1966, right there. And we're going to go to the beginning of the end of 1981. And I'm going to show you what the S&P 500 did. If I can get it going here, right there, the end of 1981. All right, so then we're going to go and we're going to hit right there, calculate. All right, so the S&P 500 was at 93 on January 1996 and ended at 123 in 1981, excuse me. All right, the earnings was $5 for every, so $5.24 for $93 of a price. So we take our trusty calculator, 93 divided by 5.24 at a PE ratio of 17.8 basically. Fast forward till here when the price is 123 and yet the earnings are 15. 123 divided by 15. 8.2. So the PE ratio went down in half. And it's going to get even worse if we started in a different time, like 1972. And I'll get in that here in a second. Well, it gives us right there. Oh, sweet. I didn't know that. So right here, we got a PE ratio of 18 versus a PE ratio of 8. And yet earnings went from 5, basically tripled over that time. Earnings tripled over that time. Interesting. So while the earnings were going up threefold, the PE ratio dropped by 50%. So what happened here? What did you make? Inflation of 7.5, 7.05. So your index rate of return with full dividend reinvestment was 5.87, which was less than the rate of inflation. Without dividends reinvested is 1.79. Even though earnings went up by threefold. I hope this makes sense. The PE ratio just fell. Now that's in 1966. Watch this. And I tell you, man, I've kind of discounted the PE ratio. I just forgot. I was like, man, that's nuts. So we're going to go to 1972. Let's see here. It just doesn't really matter. PE ratio is 18. Let's go to end of 1972. P ratio is 18. So here you got index price 117. It grew by 6 points over that 10 years. The PE ratio was 18 and went to 8. The earnings was 6 and went to 15. And yet, if you would have not reinvested your dividends, you lost 8% a year. And yet, if you would have reinvested your dividends, you lost 3.7% a year net of inflation. Check this out. See the PE ratio of McDonald's? It was 83 in 1972. It fell to 9 in 1980. So I was doing some research. Watch this. So McDonald's, coincident is from 1981. Coincident with a reduced rate of growth is McDonald's rapidly rising dividend. McDonald's formerly paid 10 to 10% of earnings using most of its cash to finance new stores. Now much of McDonald's excess cash is being used to retire debt since less is needed to finance new stores. This analyst couples a 15% annual growth rate with the company's 1 to 2% dividend yield for a total return of 16%. Annual earnings growth year over year plus dividend yield. 15% with a 1 to 2% dividend yield assumes a total return of 16 to 17%. This assumes no improvement in the PE ratio, which is currently at 8.5. 8.5. And I remember I showed you it was from 1980. It was at 9. It actually fell from 9 to 8.5, even though their earnings growth was going by 15% or more. It's crazy. It says McDonald's has a below average total return and an above average PE ratio. And he says he's not recommending this stock because he believes they're worth 70 compared to the current price of 64. Why? Because he's going to recommend these other ones. The 1,000 companies that E.F. Hutton follows show an average earnings growth of 14% with a yield of 5 for a total average return, as we just saw. Total average return. So it's total average return of 19. So McDonald's is only expect a 16 to 17% growth rate or rate of return. The other stocks, because they have a higher dividend yield with a 15% growth rate, is 19%. Is what their expectations were. And they were right. That's what happened. 82 and on, these companies were freaking going crazy. And yet those companies had a PE ratio of 7. 7. It's insane. So check this out. Watch this article right here. This is going to come together, man. You're like, well, okay, Josh, what did we learn by the 70s? Hold on a second. McDonald's shares peak in January 1973 at 77. The high water mark ended an ever-increasing bonanza for investors. Let's see, because the bear market hit every stock in the early 70s, and they have simply not reattained the levels of that period. Isn't that crazy? So within 5 years, not even close to getting back to the 77 marks. Check this out. But the current stock price of 40 and a quarter is nevertheless little more than half the peak level, although McDonald's earnings have increased fourfold since 1972. The PE multiple has dropped dramatically from the extraordinarily peak level of 75. Clearly, then, the shares are way ahead of themselves in January 1973, as were those of most growth stocks, and that's what we're learning here. I mean, can you hear that? Their earnings went up by 400%, and yet the shares went down by 50%. And now their PE ratio is like 8. Now I want to take the most recent Form 10-K, their SEC filings. Check this. All right, so the United States SEC, because SEC is really looking out for us. Really, they are. So let's check this out. Look, this is from McDonald's. And look, This is freaking nuts, dude. All right, so right here. The company has paid dividends on its common stock for 47 consecutive years. They only started paying the dividend in 1976. All right, so they paid, and that's literally 5 years after I was born, 6 years after I was born. They've been paying for essentially the bulk of my life. The company has paid dividends on its common stock for 47 consecutive years and has increased the dividend amount every single year. The 2022 full dividend of $5.66 per share represents the quarterly dividend paid for the first 3 quarters and a higher one at the end of the fourth quarter. Let's see what this says right here. That was a 10% increase in the quarterly dividend, equates to 6.0 per share annual dividend. It reflects the company's confidence in the ongoing strength. Now, this isn't about McDonald specifically. I just said, look, their dividends per share, $5.66, was up from $5.04, and now it's going to be at $6.08. $6.08. 504, 525, 566, 608. Dividends paid, 370. That's billions of dollars, man. Billions of dollars. All right, they're not even buying that much shares back, so that's good. They're paying the money in dividends, so that's what you want. Anyway, so what I'm trying to say is, the earnings, when the earnings growth of this when the earnings side of this gets hit. Woo! That can really, really, really hurt you bad. Even if this side, the dividend yield is going up. In fact, the dividend yield will be going up more as the price goes down, that's for sure. Not the earnings growth, I'm going to say the PE ratio, as the PE ratio is getting hit. As a PE ratio is getting hit, that's huge, dude. Huge. As the PE is dropping like a brick in water, again, from 80 to 8. It's nuts. I don't care how much your earnings growth are going up. I don't care how much your friggin' your dividends are going up, and your dividend yield will be going up too, because as the price goes down, it makes your dividend go up, assuming the dividend stays the flat. In this case, it's going up. It doesn't matter. You can't buy growth stocks like this, because if earnings drops like a brick in water, your butt is screwed. So check this out. 1972, McDonald's earnings hits record total. McDonald's Corporation has reported record earnings for both the 9 months and third quarter ending September. The president said for the first 9 months they totaled a 42% increase over the 1971 in earnings. Earnings per share increased 40% to 70 cents from 50 cents a year ago. Third quarter, look at that, 41%. I mean, that was in 72. And then we know what happened after 72. The bottom fell out because the earnings were too high. The price is too high. 1974, McDonald's reported record earnings again. Earnings for the first 6 months were up 31% from the 1973 period. Earnings per share increased 30% from 1973 to 74. It didn't stop the freaking Fraggle Rock, dude, because the market said, I don't want to pay for $1 of earnings in the nosebleed sections. 73, 74, the price got smoked, and yet people were still saying, I don't want to pay it. I don't want to pay it. I don't want to pay it. It didn't matter what the earnings did. McDonald's has reported record earnings, revenues, and sales for the 10th straight year. 10 straight years of record earnings. Earnings per share were $1.70 per share, an increase of 30% from 1973, and this is 1975. Net earnings are up 29%. Total sales, this is going 1973, 1974, 1975. It doesn't matter. It didn't matter because people did not want to pay, and this is their first dividend right there. So to stymie, I guess, the stock decline, McDonald's announced its first cash dividend in its 21 history. At the same time, reported record net income. Shareholders that they're going to pay 2.5 cents per share, equal to 10 cents on an annualized basis. Didn't matter. Price just kept dropping. Now, the interesting thing is, I want to show you guys something. Watch this. Inflation versus dividends of the S&P 500 going back to 1926 to 1980 something? Yeah, 1980? 1990. You can see the dividends outpaced inflation using the CPI. Now, we've known we don't use the CPI for our own personal inflation, but be it as it may. The increase in dividends outpaced the rate of inflation from 1926. It didn't matter, though. I mean, it mattered in the long haul, but not from that time period from 1966 to 1982, because the PE ratios, the price that people were willing to pay just got destroyed from basically the 70s. And that's what we've learned. We've learned that growing dividends are freaking wonderful. Growing dividends are a way to hedge against inflation, 100%. It's not stocks, though, man. Stocks don't hedge against inflation. They just don't. I mean, it can, but that doesn't mean they will. I cannot stress this enough. You cannot buy high, expensive stocks with a high PE ratio. There's just no two ways around this, man. Now, high PE ratio today relative to the 1980s. Well, again, the 1980s we had a 10-year Treasury bond at 6. Or hell, back then it was like 10-year Treasury was like 16. So now it's at 3.5. So you can see that the PE ratio should be higher because the 10-year Treasury is much, much lower. I don't have any qualm with that. That's why the whole thing with the CAPE from Schiller is so bothers me. Like, yeah, but dude, the rates on comparative money is different than it was back then. So everything, nothing is in a vacuum here. Space is, yeah, good luck with that. Anyway, the point being is, I get it. So what's a high? So is Apple, for instance, trading at 30? Is that a high PE? I don't know, man. I always got a lot of debt, and I was surprised when we looked at Apple the other day on the live stream. I was like, damn, I had a lot more debt than I would have thought on the live stream we did for locals. So join my locals channel. The issue is that we have high PE ratios, even if the earnings grow sufficiently to I'd say justify, because you're not going to be able to justify it. People at some point are going to turn their noses and say, I'm not buying that. What was Tesla done lately? And Tesla's a perfect example of this, man. Let's take a look. I haven't looked at Tesla for a while. I have no idea what's done. I imagine it's probably dropped. But I don't know. Even with the government backing of Tesla, yeah, so this year is, well, it's just year to date. Oh, yeah, it's got smoked. So Tesla's now down to, for 2 years, it was at the equivalent of 409. Damn, now it's down to 170, and that's up from the bottom of 113 it was in January. So, Tesla's had a nice little run this year, but it's got a PE ratio of 47. That's not that bad. That's too high. Without question, it's too high. Amazon, I think, its PE ratio is now in the tank. I don't even think it has a PE ratio because at 246. Crazy about that. I think Microsoft is actually pretty low, if memory serves. Maybe Microsoft was high. Facebook was low. I can't remember. Microsoft, 33. Yeah, maybe it was Facebook that was high. FB. Meta, 29. All right, that's not that bad. But anyway, and that's even with a pretty big run here, too. The point being is so I'm not sure I don't really care that much about growth stocks. What are the growth stocks? What we learned in the 70s is that even with increasing dividend payouts that were matching the rate of inflation, even with earnings growth that was dwarfing the rate of inflation, the facts are the price to earnings ratio, the contraction of PE, smoked you, man. If you didn't have to sell shares, you didn't care. But if you're retired and you're just living off your dividends, all right, well, you're going to have a whole lot of capital in which to live off your dividends. We're talking a whole lot of capital because now we're getting freaking 2% on the S&P 500. I don't even think it's that. I think it's 1.1, 1.8. So $100,000 of capital would give you $1,800 a year to live on. That ain't going to get the job done. $1 million of capital will give you $11,800. That's not going to get the job done. So you're going to have to sell some shares. There's just no other way around that. So if you're selling shares when they're trading at nosebleed, a la Amazon, Tesla, and all that stuff, your goose is cooked when people say, I'm not going to buy those shares anymore. This is what we learned from the 70s. Well, I'm going to have growing dividends. Well, growing dividends, that's great, but you only get 1.8 now. It's not enough to live on. You're going to have to sell shares. And we don't want to sell shares that go from a PE to 80 to 9, like what happened at McDonald's. And it's not just McDonald's, it's a nifty 50 stocks and whatnot. It's nuts. And those are blue chip stocks. Can't afford that. So buy low PE stocks that pay dividends without question. And to McDonald's credit, it's paid a dividend each and every year for 47 years and has increased them by 10%. Not by 10%. And maybe it was, I can't remember what I said. It's increased them every year. So to their credit. But man, you got to be careful, dude. You got to be careful. This isn't a time to sit there and say, I'm going to gamble some of my portfolio on something. What's Southern Company? So I bought some Southern Company the other day. I'm going to buy 200 shares, 100 shares, something like that. So Southern Company is trading at PE at 23, and it's got a dividend yield of 3.82. Again, that's low relative to what McDonald's was doing back then with a high PE. But 23, that's fine. But that's historically on the high end. But you can't look at it like that. I bought some. What's Exxon doing right now? Exxon, oops, X O M. Exxon's got PE of 7, still down to 7. That's nuts, man. It's still got a nice dividend yield. It's up to 108. And again, I went from 30. I rode that sucker from 34 to 65. I got out. I bought UGI, and now Exxon's doubled, and UGI is not doubled. That's for sure. UGI is it's gone the way of the dinosaur essentially. It's getting smoked. Still got a nice dividend yield, but man, the PE's on the high end. So we gotta wait for the earnings to come back around on that, man, because that's ugly. That's for sure. So I got smoked there, but I took my gains and got to ride your winners, man. Ride your winners and cut your losers. That's for sure. All right. Whatever your thoughts. We'll see you